Hello YouTube, this is D-Dub, your normal investor, and today I wanted to go over Apple's earnings report that they released November 2nd so that basically I can try to demystify earnings reports for everyone. I know most people get very nervous about looking at financial statements, and so what I wanted to do was try to get rid of that notion by analyzing companies for you, allowing you to see kind of how I analyze companies, what things are important to me. I won't necessarily go into all of the details that are important to me when it comes to financial statements, but I will kind of stay somewhat on a surface level to continue to make the videos entertaining and not as dry so that you'll be able to follow along. And then after doing a number of these earnings reports, hopefully you will start getting, I'd say, comfortable with looking at financial statements. So with that being said, I want to go ahead and say, let's go ahead and get started. So today we're going to look at Apple's income statement. So we're going to focus on the quarter and we're going to focus on the full year. And we're going to be comparing those to the previous quarter, Q4 earnings report and the previous year's earnings report. And so what I want to do is today just kind of get into kind of what Apple has been doing, and let's analyze the income statement just for a little bit. So as you can see in Q4 23, Apple earned $89.5 billion, and previously Q4 of 22, Apple earned $90 billion. And that's about, I want to say, a 1% decrease. And then when you look at the full year report, you can see that Apple earned about $383.3 billion versus $394.3 billion. That's about $11 billion decrease. And you're looking at about a 2.7%, 3% decrease in revenue. And we can see kind of there are two categories of revenue that Apple generates revenue from. One is products and the other is services. And so you can kind of see, like if we're just focusing on Q4, their actual products revenue decreased to $67.2 billion from $71 billion. And the question really is kind of what was it in their products that actually caused it to decrease? We saw an increase in services from 19 billion to 22 billion. And if we're looking at the full year of products, we're looking at 298 billion versus 316 billion, and for services 85.2 billion versus 78.1 billion. And so we see services has increased for the full year and increased for the quarter. But again, we see that, looking at this thing in its totality, we see that products has decreased and services increased. So again, the question is kind of how I look at income statements is I try to look at income statements as a person. So if I'm going to lend somebody some money, which essentially is how I view investing in a stock, I look at the financial statement of the business as a person. So right now I'm looking at Apple and I'm considering Apple a person, and they're coming to me to see whether or not I want to invest in them. So the first thing I go in and say, okay, Apple, I see that your revenue decreased from the previous year. What was the reason? Always keep that in your mind when you're evaluating a company. What's the reason for the increase? What's the reason for the decrease? Things like that that'll help you try to craft a story about what's going on with the company. So if we come here, first thing, again, we know that the revenue decreased because of products. What other things do I like to take a look at before I move on? One of those things is absolutely research and development. I like to see, like in this particular case, you can kind of see that Apple's research and development has actually, the expenses has actually increased. That's important to me, but I'll get into that reason in a second. But another thing that I like to take a look at is the gross profit margin. So for the full year, we're looking at about 169 billion versus 171 billion from the previous year. This is, it's going down, but we know that it's going down. Sorry about that, because we know that Apple has essentially been losing revenue or decreased in a product area. And so, but one thing I wanted to focus on is if we take a look at the actual gross profit versus the total revenue, we can see that this is about 44%. And this one is about 43% from previous years. So it's actually increasing in the gross profit margin. And the reason why is because the services sector, which doesn't take much to produce revenue, the cost of it doesn't is not much, is that the margin of this business is something like 70%, right? So the more that the services business continues to increase, the actual higher the margins will become for Apple's business. So this is absolutely fantastic. I actually like this. And again, this is something that I pay attention to is the gross profit margin and seeing how I like to see that specific margin and where I like it to be. Typically, I like the gross profit margin to be somewhere around 35% and higher. That's the way I typically like to do it. So in order to do that, essentially what you want to do is, sorry about that. Let me do something else here. You want to take this number, your gross revenue, right? And then you want to divide it into the gross profit. So that will basically give you your percentage. And I typically look for about 30%, 35% and higher. Now, some people like to have this around 40%, and that's okay. But I think that there are some very solid businesses out there that are sitting around 35% that are still okay. But typically, you want to have that bad boy above 35% or higher. And in Apple's case, at least for this fiscal year, it's looking at that this is about 44%. And if I look over kind of like the long term history of Apple, like, you know, back about 10 years, Apple typically averages about 40%. So, having it to where it's producing around 44% and, 43% is pretty fantastic. So, again, that's something I like to take a look at. Seeing its actual margins increase because the services business's revenue is increasing is pretty incredible. The next thing I like to do is just kind of take a look at the net income. So from Q4 to the previous Q4, there was an increase. And then from the year, though, we saw a decrease. So about $97 billion. And previously, it was about 99.8 billion or $100 billion. So we saw a nice almost $3 billion decrease in net income. And again, some people would start panicking because they're seeing the actual decrease in revenue or income, and they're seeing a decrease in revenue. But we can start taking a look at it and seeing if there's something that we want to worry about. So one of the things that I just pointed out before, like I said, is to take a look at that, increase in research and development. That $30 billion is important because that tells me that Apple is continuing to view ways in which to increase their income. They're looking at ways to improve their products. They're going out and trying to find other streams of income. And so as a person, if someone's going out and I'm seeing that they're spending their time trying to find other avenues or other businesses to make money, that's a good sign, especially if they're doing great things with their capital. And we'll take a look at kind of like that in a second. But before we deep dive, let's take a look at kind of the 5 different categories where Apple makes its money. It makes its money from the iPhone, the Mac, iPad, wearables, and services. Okay, so it has 5 businesses. We can take a look at kind of like, from a product area, out of the 4, what actually caused the decline in the revenue, right? Because we saw about an $11 billion decline. So what we want to do is just take a look. So in Q4, we saw an increase in iPhone sales, right? However, year over year in the full year, Apple actually declined from 205 billion to 200 billion, right? So there was a decline there, but that's not much. We're okay, right? We're okay there. If I'm looking at kind of the actual Mac, right? Here's that $11 billion. Okay, last year it was 40 billion versus 29 billion now. We take a look at kind of the iPad, right? So the iPad was looking at about 28 billion this year versus 29 billion last year. So there was a decrease there. We also saw a decrease in the wearables department, right? Because, the Apple Watch and all the other devices that we have, the AirPods and all those different things, we saw a decrease in the wearables business of almost 3 billion. So, or two, about 2 billion. So if I'm looking at this and I'm seeing that, about a billion, 2 billion decrease, that's not that much for me. Where the large impact, where they were really, really heavily impacted, was from the iMac or the Mac, sorry. The Mac actually decreased significantly. And then when you're looking at services, that's your Apple Plus, the Apple TV. That's your cloud that you pay for. There's a number of things. Your streaming music, right? Apple Music, like that's all of those things. So it actually went from 78 billion to 70 to 85 billion. So we saw a large increase there, which offset kind of these other declines. But it wasn't enough to offset the decline inside of the Mac. The Mac was such a large thing, and that would make me very, very nervous. So Apple again has its five businesses: the iPhone, it has the Mac, it has the iPad, it has wearables, and then it has services. And when you're looking at that, you could just take a look at the full year. Apple has five Fortune 500 companies in its company. That's absolutely amazing because there are a bunch of Fortune 500 companies that aren't making $200 billion, $30 billion, $25 billion, $28 billion, $80 billion, $90 billion. And Apple has five of them. This is an absolute incredible thing. Now, to go back kind of to the research and development, remember, Apple started as a computer company and was selling Macs, right? But it was pumping money into research and development, and it gave us the iPhone, right? And then a little bit ago, we didn't have wearables and services. So Apple always finds ways to generate revenue. That's why when you see that they're increasing the expenses in the actual category of research and development, do not get turned off by that, because they took a company that was once a computer company and they started selling phones, and that is now a $200 billion business. They went again from a computer company to selling services, and now it's an $85 billion business. So again, people need to sit back and just be very, very appreciative of kind of what Apple does with its money. So these are the things that I kind of look at. I like to look at the breakout, kind of see where the story is going, what's going on. I would like Apple to kind of take a look at the Mac and see what's happening. Maybe they need to do a refresh on their Macs. I'm not sure kind of why the revenue is declining so much. Because again, when you're looking here, you're looking at about like a 33% decline and a 26% decline, so it's pretty, that's a pretty tough decline, and I wouldn't have expected the Mac to fall so heavily. But again, I'm not too concerned because you're continuing to see from the services business, that service business is continuing to pick up and offset some of the declines in that. But it's only going to grow so much. So Apple needs to figure out a way to continue to, either increase the categories that it has in revenues, or it's going to need to find another business to add to these categories that will allow it to produce more income. And you don't want it to cannibalize its business. So you just want it to kind of expand. And Apple has a great ecosystem this way. So again, this is absolutely fantastic. Out of the Q4 of the $89 billion that it made this year, having the iPhone take up a huge portion of that, and then having services take up the other portion is pretty fantastic. It shows you that Apple has an incredible ecosystem, even though we're seeing revenue decline. And so the next thing I want to do is take a look at the balance sheet to see if there are some things that, maybe I need to be concerned about, or I need to be very, very encouraged. So let's move on to the balance sheet. Okay, on the balance sheet, there are a few things I will show you that I'll pay attention to on the surface. Again, I typically take a look at the 10Qs and the 10Ks to do a deep dive on the analysis of the financial statements, but on the actual preliminary release on their financial reports, I like to get an insight of like what's going on with cash, the cash that they have on hand, just taking a look at their total current assets to see what that looks like. And then I also take a look at kind of their total current liabilities, right? And then the other thing that I like to look at is the debt. What does the long term debt look like? And before we get into all of that, let's go ahead and just start with the cash on hand. So we see that the cash on hand actually increased. So it's about $30 billion here, $23 billion there. So I mean, you're basically looking at about $7 billion. So you just ask yourself, hey, where did this $7 billion increase come from? And what we will do is when we look at the cash flow statement, that will let us know where that money came from. So, but right now it looks really nice. I'm sitting there and I'm extremely excited that Apple is increasing its cash. The same thing. If a person came to me and they were looking for me to invest in their company, and I saw that they were increasing the cash on hand, I'm like, oh, after looking at their income statement, seeing that it declined a little bit, but they're finding ways to continue to bring in revenue. Like Apple's net income was still like $97 billion, which is pretty hefty for a profit. There are companies out there that don't even bring in the revenue of $97 billion, and Apple profited $97 billion. So that's absolutely incredible. So I'm pretty happy about that. But then I'm seeing, oh, and they, basically was at a point where they're putting in about $7 billion into the bank. That's absolutely incredible there. So this is one of the things is that I'll take a look at the cash flow statement to tell me kind of where that actually came from. But in the meantime, I'd like to take a look at that. So now that I know that the cash has increased, now I want to take a look at kind of this. I'm sorry about that. I want to take a look at kind of this number here. The total current cash is looking at about 144 billion versus 135 previously, and I'm going to move myself up to the top now. So hold on just a second. So when I'm looking at the actual total current assets, it's about 144 billion versus the total current liabilities. Now, why is that important? It's important because as a company, right, the total current assets are the assets that are actually you can redeem within the next 12 months. So it's either loans that you've given out or equities that you've purchased that are all going to be readily available immediately to give you cash. And so that's one of the things that you want to look at it versus the current liabilities, which is the amount of debt that will become due within the next 12 months. And what you want to do, at least for me, I like to look at that and say, for every total current debt, every dollar that I have in current debt, I would like to have a dollar in current assets. So that means that if my bills are coming due, if I have a dollar of bills that are due, I have a dollar of assets that will be able to take care of that. So I'm not negative. And the thing is that in the past 2 years, as you can see, this 143, 144 minus the 145, we're negative this year. We were also negative last year at 135 minus 153. So our working capital was actually negative. In the previous 9 years, that number was always one or higher. And so now you would ask yourself, like, hey, would you be nervous about something like that because their working capital is not so well and the current ratio is just, not one or above? And to me, I'd say no, because one, Apple is like a triple A company, extremely solid, has a solid business. We looked at the income statement. We see that it generates lots of cash. And then on top of that, looking at this actual balance sheet, we can see that they've been increasing their cash. We'll find out how they did it, but that looks good. They have $30 billion in the bank. I'm sorry, and I'm extremely happy for what they're trying to do or what they've been doing. So seeing the past 2 years where their current ratio isn't one, I'm okay with that. So, and if that they actually had all of their bills come due in that 12-month time, their current total current debts. I know that Apple has such strong credit rating that they actually be able to go out and borrow money. So again, as a person, I would say your credit rating is so strong, I know that you would be able to go out and borrow money if all of your bills came due and you needed to pay it right away. But most of the times when the company isn't doing strong from the income statement, it's not a really, really strong company, and you see that that current ratio is not a one, which again would be your total current assets divided by your current liabilities. If that ratio isn't one and higher, you normally get very, very leery of that because that company can basically file for bankruptcy, especially if it doesn't have a strong credit rating. So be very, very cognizant of that. And that's one of the things that I like to take a look at. The next thing I like to take a look at is the long-term debt. Now, we're looking at the long-term debt of Apple, which is sitting at about $95 billion. And how I like to look at it is I like to divide the long-term debt by the actual net income. And what that does is basically tell me, it says, hey, if you divide that, the long-term debt by the net income, all things being equal, if it keeps making money, the business keeps producing the same amount of net income over the next whatever years, how long will it take to pay off the debt? And in Apple's case, remember, the Apple's net income was about $97 billion. It has long-term debt of $95 billion. So basically, Apple could take its net income and pay off all this debt and still have $2 billion left over. So to me, that's absolutely fantastic. What I like to do in these particular situations is I typically like a company where the long-term debt divided by the net income is less than 5 years. Okay, I'll repeat that again. I want the long-term debt divided by the net income to produce an integer that's less than 5. Okay, that's important because I know that the business is extremely strong, right? And you want to be able to look at these type of things inside the business and be happy about them. So again, looking at the long-term debt is very, very important. So hopefully the company that you're looking at produces net income. If it doesn't, man, you got to be a little bit worried. You don't want the company its net income to be negative. So I love to invest in strong businesses, and Apple is one of those strong businesses. So that's the next thing. The final thing that I will point out to you all that you should look at is the equity. Okay. The actual shareholders equity. Okay. And what that is that it's essentially just the total assets minus the total liabilities. Okay. And so that's what's left over. And you can see that from previous year to this year, the actual total equity has actually increased. Now, what do I do with this? I typically will go in, take a look at the net income, which was $97 billion, and divide the $97 billion by the equity. Now, you may say, well, what is that going to tell you? Okay, this is how I want to put it. Again, I treat every business like it's a person. Say that a person said to me, hey, D-Dub, I invested into this real estate deal. I put $100,000 in and the profit to me is $20,000. Then that person is making a 20% return on its cash on cash return. Okay. That is absolutely fantastic. So I look at the equity in a business, right, in a publicly traded company as the equity that a business has put into the business. So in Apple's case, theirs is $62 billion. And then they actually had a net income of $97 billion. So that was their return. So they're looking at about 156% return. Okay. That's incredible. That would be like them, again, taking the $100,000 example. You put $100,000 into an investment, and then all of a sudden you came to me and said, yeah, you're looking for me to invest. And you say, yeah, my return on investment on the $100,000 I put up was about $156,000. You got 156% return? Yes, I did. I made $156,000 this year. That's phenomenal, guys. That's absolutely incredible. It would make you want to keep investing with that person. So that's what is important about looking at these income statements, the balance sheets. You really want to get that story. You want to feel very, very comfortable in investing into a business like Apple. So that's something that I wanted to point out to you guys, that again, this is surface level. There are a lot of things that I look at more on the balance sheet, but this is the stuff that you should be doing, and I think it's strong enough for you to be able to make assessments. So again, it's really important for you to kind of take a look at these type of things and view the income statement, the balance sheet, and the cash flow statement to make yourself feel pretty comfortable. So next, we'll go ahead and get into kind of the cash flow statement to see where, in fact, that $7 billion came from. But before we do that, the last thing I want to point out about the balance sheet, and this is important for me, and I think it would be important for you all too, is just when you're looking at the balance sheet and you're taking a look at the long-term debt, you're taking a look at kind of what the how many years it'll take to pay off, and you move on to the equity portion of it, and you're trying to see what the return is that they get on their investments. That basically says to me, D-Dub, when that company invests, or that person, right? So that person invests, they typically get a great return on their money. So when I look and see that their R&D is increasing, I'm not worried. Why am I not worried? They received 156% return on their capital. So I'm not going to be afraid at all. And another thing is that a company that does that tells me that they will continue to grow their revenue. So I don't get concerned about the future growth rates. So if I'm looking at a company that says, hey, it's going to grow about 15% or so and so, I take a look at their return on equity. That is the net income divided by the equity. And if that number, that percentage, is, I want to say 15%, because that's how I look at investments for me. If I invest in a property, if I invest in a stock, I want to get about a 15% return. And if a company is able to give me a 15% return, because it's owner's equity, right? That's how you look at it. Then great, fantastic. And that's what I would say regarding Apple and any company. You look at it and say, what type of returns are they getting on their investments? And you do that just by taking a look at the shareholders' equity and seeing what the net income is versus that. And if it's fantastic, always think of it as if you invested, hey, I put, $100,000 into a deal, I got $50,000 profit off of it, this year. That's a 50% return. That's incredible. So any company that's doing numbers like that is just like, if they told you that they want to go in and invest in research and development to figure out what other businesses they can start, or can they invest in the businesses that they have because they feel that they will be able to grow more, you let them do it, because they are showing you that they're giving you a fantastic return on the investment. So that's that. Now we can move on to the cash flow statement. Okay, there are 3 sections in the cash flow statement that are important. Okay, one is the actual the money that comes from the business. Okay, is what is called as operating activities. Okay, that's the money that comes from the business. That's the income it's producing. The second one is the investing. Okay, that is what they're, if they're buying marketable securities or selling marketable securities, right? Investments that the company is making. They're also financing capex situation. So if they have to improve equipment, replace equipment, buildings, all of this stuff. So that's the investing activities portion. And then the last thing is the financing activities. Okay, that's when they are borrowing money, paying out dividends, repurchasing shares. These are the 3 sections that are taken up by the actual cash flow statement. And what's important about this is that it allows us to truly see how much a business actually made in its actual cash. Okay, so when a business is making money, they try to find ways to offset their tax liabilities, and they do that by taking into account depreciation, amortization, and all this other stuff. And a lot of this stuff is not cash being taken out. So we have to rectify that in the cash flow statement. So, when you go in and you say, hey, a property depreciated by this amount, or an equipment depreciated by this amount, you didn't pay out that amount of money, right? That was a theoretical number. So in the cash flow statement, you reconcile that by putting it back in. So we were talking about, Apple generating about $97 billion of net income. But when we start adding things back in and taking some things out, they really generated about 110 billion, 111 billion for 2023. And so that's that's a lot of money. So you take a look at that, then you juxtapose it to kind of what they've done with investing. So with investing activities, hold on, let me move myself. So in investing activities, they actually sold a lot of marketable securities. So whatever it is, stocks, bonds, whatever, about $40 billion worth it. So they were able to profit off of that and bring that money in. But they also bought and purchased some marketable securities as well. And so when you're looking at that, their capex was about $11 billion. So whether they're buying new equipment or buildings or any of that other stuff, or refurbishing equipment or different things like that, it's about $11 billion, right? They're still trying to grow their company and make sure their company continues to operate with the best things to produce the revenue that they need to produce. And so with that, because they sold so many marketable securities, they were able to bring in about $3.7 billion from that. Now, here's a little thing. I like for this number to be positive. I like for this number to be negative, and I like for this number to be negative. But I'll get into why in a second. Then the last thing is that from financing activity, we can see that they did a lot of repurchasing. They repurchased a lot of stock. Hey, we like that, because the more they eliminate stocks, our actual value in the company increases. They actually purchased dividends, like they gave us some dividends as shareholders, right? So that's absolutely fantastic. And then they paid off debt. Okay. And so with all of this, they ended up basically in financing activities, they spent about $108 billion. Now that's incredible. Okay. Now, to go back to why I like for these numbers to be negative, is one, I like for this to be positive because it says, hey, they're making money in the business. This to be negative because it's saying, hey, man, like what you're doing is you're buying investments. I like for you to be buying investments, right? Just like here, last year they were buying investments, so that number was negative. And so that's typical. When a company is selling the assets that it has, I start to get a little bit worried. So if you start seeing a company doing a lot of selling of assets, be very, very concerned. And the same thing with financing. That means they're taking on a lot of debt. So if this number is positive, it's because they're taking on a lot of debt. They're borrowing a ton of money, and borrowing a ton of money is not always good. So you want those numbers to be negative. And that's kind of how I look at it. So let's go back and finish this up. The reason why there was an increase in cash is because they made a lot of money from the business. And then they also, sorry about that, they also went and sold some securities. Okay. And with that, after paying off the actual, their financing activities, like their debt, repurchasing shares, and also paying out dividends, they were able to walk away with about $6 billion and put that into the bank. So that's where they actually made their money. It was from the business and selling marketable securities. So when I'm looking at this company as a person and they're like, hey, D-Dub, will you invest in me? I'm like, okay, well, now I've already evaluated your financials. You look very, very strong. The next step is progressing to kind of the stock and seeing what is the stock trading for? What do you want me to purchase it for? Or what should I purchase it for? And so that's kind of the next phase into going in and taking a look at the stock. So I hope that you guys have all enjoyed this journey. It's been fantastic for me to do this. I'm going to keep on doing it. I'm going to keep on evaluating businesses. Hopefully, this was entertaining and that you were able to make it through. Hopefully, you made it through to the end. And again, until next time, that's this time. This is D Dub, your normal investor. I'm out. Later.